Hello, everyone, and welcome to the March Pensionmark webinar, where we'll be discussing market volatility. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on your webinar menu. And third, this webinar is set up to be interactive through the use of polling questions throughout the presentation. We encourage you to participate as the questions arise. At the end, we will take some time to go through the questions you've submitted throughout today's webinar. And now I'd like to introduce our guest speaker of Invesco, Tracy Fielder. Tracy is a senior strategist of the Rethinking Risk Thought Leadership Program. He heads a team which develops the themes, researches the data, and presents the concepts concerning risk and volatility in the market and how it can affect a client's portfolio. The Rethinking Risk program is Invesco's approach to looking at risk holistically by considering market history, investor psychology behavior, and asset allocation theory application. This program and philosophy also looks at portfolio construction by diversifying across sources of risk in relation to various market and economic environments. Thank you so much for joining us today, Tracy, and with that, we'll turn it over to you.
Thank you so much, Tori, and thank everybody for joining today. I know you folks are busy and you're taking time every day, so we really greatly appreciate that from myself and from here at Invesco. First of all, I wanted to kind of tell you what we're really here to talk about today. As Tori mentioned, we're here to talk about, it's really kind of a hot topic of discussion. We've seen in the headlines, whether you watch CNN Money, or you just watch CNN, or you watch just your local news, typically you're going to see discussions about stock market volatility. The market's up 300 points one day, the market may be down 300 points one day, sometimes back to back, one day up, one day down. So very hot topic of discussion, and so we want to talk about that, and I'm sure you all are to varying degrees familiar with that. And so really what I wanted to do is kind of set this up for you to talk about how do we deal with volatility. And I think a good way to do this is looking at our system of government. We're having elections coming up, so what more of a timely way to discuss market volatility than let's talk about how the government's set up. But one of the most defining features, I would say, of the United States government is their separation of powers. And we all learned this in grade school. We have the executive branch, the legislative branch, and the judicial branch were basically designed to give us a system of checks and balances. And so the point of that is a branch of government doesn't have a stronghold or influence over the future of the country at any place in time, and we always have that checks and balances working to keep those in check. Well, if you think about it for a second, as we kind of walk through this presentation, keep that in mind, because this same concept really holds true for portfolio construction. Portfolio construction, what that simply means is how do you invest and what do you invest in to construct your retirement savings plan, because you folks here are mainly investors in the retirement savings plan, but you may have investments outside of that as well. So in order to really have a true system of checks and balances in a portfolio, investors should include a variety of asset classes. So that really what you're looking for is that the volatility of a single asset class, like stocks, doesn't dominate the outcome of your financial goals. And we'll talk about that in a minute, what that means. And so I think investors typically, and you've heard this before, do the wrong thing at the wrong time. It's the easy adage of saying buy high and sell low sounds so easy, and it is on paper, but it's really hard to see that when you're seeing the market down a lot, and it gets scary sometimes for individual investors, and I can understand that. I worked in this industry for over 20 years, and I've had my share of scares myself. But what happens is I think people avoid the asset class that's unpopular at the time, the thing that's underperforming at the moment. But our challenge as an investor, especially as a retirement plan, is to try to not to try to predict or avoid volatility, because it's there. But that's an impossible way to do it. So instead, we should probably look at ways to understand it, look at the impact on the markets over the past decades, and actually going back further than that, and develop a plan of action in ways that's going to help you to hit your goals in the future. So really what we're going to look at today is three areas. The first area we're going to look at is the past and examine the historical volatility of the three main areas of investing that you would probably be most familiar with. Stocks, which is the stock market, the S&P 500, for example. Bonds, and commodities. Commodities would include oil, which has been in the headlines lately because of low oil prices, and gold, which I'm sure you're also familiar with. Next, let's look at discussing ways in which we can focus on what we can control. So we can't control what the market's going to do on a daily basis, certainly not, but there are some things that we can do to help control reaching our retirement goals. And finally, let's talk about how we can be prepared as an investor for future financial goals, and mainly through retirement savings. So if we don't mind moving to the second slide. Many investors, here we have a polling question. This is interesting, and I think this is a great way to have you guys be able to participate. But here's the first question. What is the most important in terms of reaching your financial goals? And you please select one of these options. A, outperforming the stock market, and in other words, that's the S&P 500 or some other stock market benchmark. B, never losing money. C, being able to sleep at night. D, determining your required rate of return and timeline to meet each financial goal: college, education, retirement, second home, etc. And so please go ahead and put your votes down, and then we'll see what we come up with in terms of polling questions or responses, excuse me. So it looks here, and there's not really a right or wrong answer in this, and that's kind of what we looked at here. I am happy to see. Let me move over my. I have a little box here that's hard to tell. Looks like we have 0% responded to outperforming stock market. Good for you folks. B, never losing money. That's not really a wrong answer, but if you never lose money, that means you're not taking on any risk, and probably you're putting your money in a mattress or a coffee can, so that's probably not the best way to look at it either. C, being able to sleep at night, that's a great response. I myself like to prefer to sleep at night with my investments. And then D, we have 44% determining your required rate of return. Actually, that would be 44, and 13% would be 57% with determining your required rate of return and line to meet each financial goal. So folks, you guys have done a fantastic job already looking at our polling results here, and so I think you guys are prepared to kind of start the presentation. So we're going to start off with the past, understanding the volatility of stocks, bonds, and commodities. And first, we're going to start with the stock market. That's the ones you're probably the most familiar with, ones that we learn as investors as 101 and in school. And so I think a lot of people, investors in particular, attitudes about investing, what they think about investing is based on their personal history, whether that's been good or bad in the most recent past. So let's take a look at the Dow over the high-flying time period of the bull market of 1982 to 1999. Now, during these 18 years of performance, the Dow Jones Industrial Average included only 2 down years. They only lost 4% in 1984 and 4% in 1990. 9 consecutive up years. That means right in a row, 1991 to 1999, all up years. 13 years with returns of 12% or more, 10 years of returns of 20% or more, and 5 years with returns of 25% or more. That was the heyday of the stock market. Now, based on this experience, many investors believe that their biggest risk really was missing out on stock returns. I remember I started my career back in the early to mid-90s, and I recall this. And many of these same investors that kind of grew up in this time period, or you've even read about it if you didn't grow up in that, believe that that type of environment represents really what's normal in the markets, and they really kind of hope one day it'll come back. And in fact, some of those same investors may be waiting for that type of environment to return just in time for the retirement. Wouldn't that be nice? But we know that studying market history, like we do in Rethinking Risk program here at Invesco, that markets aren't always conducive to this type of environment and an equity-centric allocation, which would be mainly stocks. So let's take a deeper look at the years in which the Dow lost more than 10%. And we look here and we see that there are time periods where the Dow Jones Industrial Average of losses of 20, 30, and even 40% are really probably not as rare as many people realize. The point of showing you this is that these are not the term black swan or tail events. These aren't rare events. Does that mean that investors should avoid stocks? Absolutely not. In fact, investors really need stock exposure in their portfolios to varying degrees depending on your risk tolerance and time horizon, but to act as your growth engine. However, the point of this is just be aware that the stock market volatility should be accounted for in your financial plan. Now let's move on to this next slide. Bonds are the asset class that many investors really kind of turn to escape volatility, or they use it as a flight to safety. In fact, you see when the stock market sells off on any given day, when the Dow is down 300 points, 400 points, 500 points sometimes, the bond market typically does well that day because investors period, are flying to safety, and then they typically do that in U.S. Treasury bonds. But why bonds really aren't as volatile as stocks, they're probably more volatile than many people think, and so I wanted to show you this. Here we illustrate just how often the bond market has experienced significant price drops, and we can see here since 1981, using daily bond prices of the 10-year Treasury, U.S. Treasury, the bond market anyway, has experienced 4 drops of at least 15%, pretty sizable downturn, 13 drops of at least 10%, and 23 drops of at least 7%. Now again, these drops may be surprising for investors that think bonds is a non-volatile asset class, because they certainly aren't based on this. Let's move on to the next slide. And we talked about stocks, bonds, and commodities. Now I don't think that anybody's going to be surprised to learn that commodities have historically been volatile. This has been especially evident given the recent drop in oil prices, right? We've seen that, and it's affecting the economy, especially if you're in oil-driven economies. I live in Houston, and this is where I work at Invesco, and certainly we feel the pain from oil prices, not to the extent we did back in the 80s, but it's still there all the less, and it certainly has an effect globally. Also, we're going to look at gold, and many investors look at gold as the ultimate safe haven asset class. So that's why we're going to look at these 2 most popular commodities asset classes. But if we take a look closer at the commodity performance, we can learn something potentially useful things. So here we compare the volatility of oil and gold to the volatility of stocks. And we can clearly see here in the oil picture, that has a little barrel of oil there, and then the bar of gold, we see the number of sharp drops of at least 10% in oil, which were 274 times oil has dropped more than 10%. And then gold has had 113 drops of at least 10% versus the number of drops in the S&P 500 index, which is representing stocks. Okay, so this is a point we want to make here. So by reading Investing 101 books, the Wall Street Journal, the Barron's articles, blogs, investing articles across the board, we're typically taught that to expect more risk equals more reward. And I would have to say, generally speaking, based on my experience, that is typically the truth. However, I wanted to make a point here. You can see from the return figures, the average annualized return of stocks versus oil was 8.34% for stocks during that time period versus 1.84% for oil, and 8.88% for gold versus 8.88% for stocks versus 4.77% for gold. We can clearly see that stocks outperformed gold and oil, although gold and oil are much more volatile. So what happened here? Well, we did this to really paint a picture for you. It's really a big mantra that we use in the Rethinking Risk program is that losses have a disproportionate impact to our returns versus gains. So it's the old mathematical example of if you lose 50%, it takes 100% return just to get back to even. In other words, losses really impact our average returns much more than gains do. So why would investors consider investing in such a volatile asset class? Well, it's because they're looking for diversification benefits through low correlation. In low correlation, this simply means that commodities will act or return differently than traditional stocks or bonds. They'll return differently at different times. And so we'll see this later in the presentation for times when commodities outperform. But for the time being, let's take a look at the next slide and look a little bit about how we look at within the commodities asset class. Well, I don't want to belabor the commodities too much because typically people don't invest in commodities in retirement planning. But all I wanted to do was touch here for a moment and talk to you about how commodities are not equal created equal. So we looked at gold and oil, and we could clearly see how there were some differences there. But if we look across agriculture or energy, which includes crude, oil, diesel, etc., and then precious metals, which include gold and silver, which you all know that, platinum, and then versus industrial metals, those numbers mean correlation numbers. And a correlation of 1, if you look on the left side of the graph here, means perfect correlation. That means if a stock goes up 10%, another stock goes up 10%, they'll have a perfect correlation of 1.0. If you have a correlation of, say, 0.2, that's a very low correlation. That means that you're either going up much less than the other asset class or the other security or investment that which you're investing in, or down more or less than the other investment, and at different times. And so clearly what we're saying here is if we look at across precious metals, industrial metals, energy, and agriculture, if you invested across 4 of those complexes, you only have a 0.27 correlation to those. Really, that's all we're really trying to show here, is that all commodities aren't created equal. Because I think the one that most people focus on are gold and oil. So that's just a representative way to look at this. So far we've looked at a few things to consider in retirement investing. First of all asset classes have experienced volatility. Stocks, we know that. Commodities, we know that. But even bonds and gold, which are considered safe haven asset classes. Second thing we learned is large losses are not uncommon, but investors just plan for them, right? We know that they're going to happen, so we need to just be prepared for them. And higher volatility does not always result in higher returns. And in the case of here, what we mean by that is if the higher volatility means more downside. And in the case of gold and oil, they had more downturns than they did stocks, and that's why they outperformed. Let's go ahead and move on to the next slide. Okay, well now we have a next polling question, actually. This is interesting. I like this. What is the biggest risk of investing for retirement? A, losing money during market downturns. B, not outperforming the stock market. C, having to work longer than you originally wanted. Or D, not having enough money for everyday spending after contributions. And so you guys have some time to poll those numbers, and we'll see what the numbers come with. Okay, great. Well, let me see here what we have in terms of polling questions. We have 6% losing money during market downturns, 61% having to work longer than you originally wanted, and D, not having enough money for everyday spending. You know, to be honest with you, nobody likes to lose money during market downturns, and I can certainly understand some folks answering that. I'm really proud to see that nobody selected not outperforming the stock market, because as nice as that is to do it, that really means if you're doing better than the stock market on the way up, typically what it means is you're going to really hurt on the way down. So we have to consider that. More risk on the way up, more risk on the way down. C, having to work longer than you originally wanted. That's one of the biggest things if you read articles about retirement savers right now. A lot of people, my dad was one of those examples that had to work longer in retirement than he originally planned. And then D is not having enough money for everyday spending. And we're going to look at some ways that maybe we can look at retirement saving, and maybe we won't have to worry about it as much during that, or to see what the impact of savings does on our future retirement plans being. So let's look at the following slide after this one. So what we did is we looked at the past, excuse me. So let's take a look at where investors are in the present, and then what actions that we can take within their power to deal with volatility. So one of the mantras that we have, another mantra we have in Rethinking Risk program, is to focus on things that we can control. So we're going to take a look at a few of those things now. Now, one of the first things that retirement savers need to do is build realistic expectations for their portfolio. So what we're going to do is look at how we can do that by looking at this graph. Now, this graph looks a little convoluted, and I'll explain to you what we're looking at here. If you can see here from 1928 through 2013, the S&P 500 on a price-only basis compounded at 5.62% a year. And that's the dark blue squiggly line. That's the actual stock market returns on a price-only basis. The light blue dotted line that kind of connects the two ends of the squiggly line is a linear return, an average return year over year of 5.62%. And we can see that as literally if you made 5.62% from 1928 and every year subsequently after that leading up to 2013, that's what that blue line would look like. Well, here's the issue. The reality of the stock market is the dark blue line. But when we're sitting down with our advisor or sitting down with doing our own financial planning, I happen to do my own financial planning, and some of you may do the same, we have to give ourselves a linear assumption, meaning we say we need to return 6% or 7% or 8% or whatever it may be to reach our financial goal, whether that's retirement or sending our child to college. And so the only thing we can do is provide that light blue line, for instance, in our financial plan. But as we can clearly see, reality many times is nowhere near where that line is. So what this basically is telling us is to pay attention to our portfolios. If you have an advisor, meet with them regularly, especially during periods of heightened volatility. And what you can do is look at, hey, this is where I am now. This is what we plan to do. This is what my goal is. And if there's a gap there, do I need to save more? Do I need to adjust my portfolio? Do I need more stocks? Do I need less stocks? Do I need more bonds and less bonds? There's something else I can do there to adjust for that, so you can constantly look at your portfolio. This doesn't mean on a daily basis, because you'll drive yourself crazy doing that. But certainly on a periodic basis, you would probably want to check with that. And so that's just kind of the point of that, is building realistic expectation. So let's look at the next slide. I think you folks will really appreciate this one, being in retirement plans and a pension plan. So not only is consistency or building expectations important, but also it's so important to maximize savings. And a point of this exercise is to show you that contributions, or your savings rate in retirement planning, is really the builder of the vast majority of your wealth. And so let's kind of walk you through this example. In each of these examples, each investor has a household income of $100,000 a year. Scenario 1, Scenario 2, and Scenario 3. So let's walk you through this. The first scenario shows if the household saved 10% a year and did this over a 10-year time period, and they earned 12% a year, or returned 12% a year on their retirement savings, they would come up with almost $194,000. Of that, 48% of that would be market returns, which is the dark blue top. The bottom light blue line is 52% of the majority of that came from contributions. So even with a fantastic market return over 10 years, 12%, that was kind of like the 90s time period, which we haven't seen those in 20 years. But even with that, the majority of your savings is built on contributions from your retirement savings. The second saver, well, they're a super saver. They saved 20%, but they were scared of the stock market. They said you could lose money in the stock market, and so they didn't put anything, but they maybe put it in a piggy bank, right? But they saved 20%, and they did that over 10 years. Well, 100% of their returns come from contributions, because they didn't make anything because he stuck his money in a piggy bank. But he actually had more money than the person that made 12% a year. Now, we make it very clear here. This is not to say to take your retirement savings, please, and not put it in your piggy bank or your mattress or coffee can, or even the equivalent of nowadays your savings account or checking account, because you don't make any money in that. You do have to take some level of risk to meet retirement goals. But what this is trying to say is that the more you save, the less risk you have to take. Less risk doesn't mean zero risk. Most of you guys picked that, and all of you actually picked that for the most part when it comes to losing money in the stock market. But I will say that the cash, as far as retirement savings, isn't going to get you there. Now let's look at the third scenario. This is really the ideal scenario. And this is basically a person invests 20% of his or her income each year for 10 years, and they have a moderate risk profile, moderate portfolio that earns 6%, not 12%, not 0, but 6, somewhere in the middle. And they bested all three of the other two scenarios, and it was the best of the three scenarios. And you can clearly see here that 73% of the portfolio was still contributions, and only 27% of that was market returns. So the point of here is decision to save more. It gives you an option to adopt a more conservative asset allocation, and so you can take a moderate level of risk, save more, and then do better than the person that's even an excellent saver that doesn't save as much. So the point of that is really building your contributions. And so some things to consider is be realistic about the volatility that your portfolio is going to likely experience. So we need to understand that there's going to be ups and downs in the stock market. And then the second part of that is focus on putting away as much as you can. Okay, let's move on to the next slide. I don't know if we're having a polling question now or if it's the next slide. Okay, so here's a tale of 4 investors. I think this is another interesting way to look at retirement savings, and we're going to walk through 4 scenarios. The first 2 we're going to look at talks about the importance of saving early. It's never too late to start saving for retirement, but the earlier you can save, the much better. So we're going to start with John. So John invested consistently for 40 years. So in an ideal world, basically all investors would be John. They'd save early and consistently. So John started from 1975 to 2014. He invested 10% of his portfolio, and he invested in the S&P 500. He ended up with $7 million. Very, very long time. Now, Emily invested the same amount, 10%, but she started in 1985, 10 years later than John did. And so that 10 years cost her, her portfolio is 1.75 million. So that's a 5.25 million gap because she waited 10 years to save. So if any of you folks are younger on the line, or you know people that are younger that have just been hesitant to start saving, even if it's a small amount, please get them to understand the importance of starting to save early, because the earlier you have, time is on your side. Let's move on to the second part of this, and we see two other investors here. And this would be talking about our pre-retiree folks, okay? And so let's see. It's the this is slide 8. I think we need to go to 9. There we go. And this is William and Jane. So William also saved for a 30-year time horizon. So the first decade, the first 10 years, he saved 10% a year. The next 2 decades, he ramped up his savings to 20%. Okay, so the next 20 years, 20% from his paycheck, and instituted here's a 3% inflation adjustment per year. So that means every year he ramped up his savings by 3%. So every year he was automatically adjusting for that. And he ended up with a portfolio of $2.52 million investing in the S&P 500. Jane was what a lot of people end up doing is they save, they put their money away in retirement, and she saved 30 years. She saved 10% annually for 20 years. But she went to meet with her financial advisor, looked at it herself, and saw that she had a pretty big gap in retirement. And so that she had saved 10% for 20 years, she saw that where she wanted to be in retirement wasn't going to get her there in the next 10 years. And so she had to vastly increase her portfolio. And so she increased her contribution to 50% of her income. And so she ended up with a portfolio of almost $2.5 million. So basically the same place where William ended up, although as you see here, because she had to do so much more in the last 10 years, she had to increase her contribution to 50%. Now, understand, myself included, understanding here in this idea of increasing your contribution to 50%. But if you read The Millionaire Next Door by Thomas Stanley or the books like this, the people with the millionaires actually are super savers, and they save anywhere between 35 to 60% of their disposable income from their paychecks. And this is really doable, especially if you're 10 years away from retirement in most cases, at least a large part of your income, because hopefully your children are out of the house by then, and if they've gone to college, it's either they're almost done or it's mostly paid for. Your house is mostly paid for, if not all the way paid for, and so you have more to spend on disposable income. And so that's something to consider as a pre-retiree if you happen to be in that boat. So the point here is you have time to make up for lost time. So let's move on to the next slide. Now this is actually when you are in retirement, and we looked at path dependency a while ago as far as building expectations. But when you're in your retirement years, the compounding of losses and gains becomes even more important, because you need portfolio income to fund your living expenses as a retiree. And so this example we have is a really popular piece that we have at Invesco that we actually use with financial advisors and investors like yourself to explain how returns can affect your retirement living and how you pull money from your portfolio. So here we have 2 retirees, and they have $1 million stock portfolio, each of them, from which they're making $50,000 or 5% annual withdrawals, and they actually adjust that 3% a year annually to adjust for inflation. Now, so this scenario, there are 2 return sequences for each retiree. The retiree A is in the blue, retiree B would be in the purple line. The difference here is the 2 sequences they're in reverse order. So let me walk you through what this means. The blue line represents the retiree A, and it's the actual returns if they invested the $1 million in the S&P 500 from 1990 to 2010. So they received those returns. They were invested. And you can see here they did really well during the 90s, all the way to 99, and then we had the tech and telecom bubble in 2000, around the 10th year, and we see that we dropped quite a bit, but still way up more than they started. Then we moved up to 2008. Then we had the 2008 financial crisis, but they ended up with, between $2.5 and $3 million ultimately. And so that person's okay despite that horrible volatility. Now let's look at this other person. They received those same returns, annual returns, but in reverse order. So in other words, they received returns from 2010 to 1990, which are obviously hypothetical. And you can see here, because they took a hit early on, going backwards, 2010, 2009, 2008, the financial crisis, boom. And then we go back and then we get hit again, 2002, 2001, 2000, that was the tech and telecom bubble. This person actually ends up at one point down to half of what they originally invested. That $1 million at one point is down to $500,000. That's a scary time, folks, and I tell you, taking a hit early on when you're taking withdrawals from your portfolio can be horrendous to a retiree. So the point of this is we want to have reasonable upside. We need to make some kind of money in our retirement and our portfolios, but we need to also be very aware of those large losses we talked about earlier, and understanding that those large losses can really impact our ability to live for the rest of our lives on our retirement income. So that's just an important part. And so for retirees, it's more important to start strong than to finish strong, right? And consider ways to potentially lessen the risk of a significant hit to your principal, which you originally invest in early on in retirement. And so you want to balancing the growth potential of their stocks with other investment options such as bonds or alternative investments that are less risky, that can help you, and even cash that may help you better weather the storm and help you diversify how your portfolio acts in those downturns. So let's look at I think it's the final slide here. Oh, we have one more polling question. Number 3, what affects investors' returns more? A, how many positive versus negative return years you have. B, large losses. C, large gains. Or D, market timing, buying at the lowest point in the market and selling at its highest. And you folks, actually, I kind of gave you the answers to this test, so let's see what you guys come up with. Okay, so A, we had 50% of the poll. B, large losses. A was how many positive versus negative years you have. That actually has to do with frequency of returns. And so if you do have more negative returns, we looked at that on the oil and gold. Obviously, that affected the returns of that. And so you answered correctly there. Large losses, we've talked about that several times throughout the presentation. The point is, it's just hard to make up large losses, and they're exponentially hurt your returns more than gains. And nobody picked gains, so you guys really listened and paid attention. So good to you folks. And then finally, market timing, buying at the lowest point in the market and selling at the highest. That's actually a right answer. The problem with it is, if I could do that consistently or know somebody that could do it consistently, please let me know who they are, because I'd like to invest my money with them. I've done it a time or two, but it all ends up being lucky more than it is skill to get that perfect point at the lowest point in the market and selling at the highest. But if you could do it, you could certainly affect your returns in a great way. So again, kind of jokingly, but and being all serious, it would be nice if I could be able to do that. So, but that's nice. You guys did a good job there. Now let's look at the last part of this slide. I think this kind of all pull things together. We talked about stocks, bonds, and commodities. And so I think what we're trying to do here is just kind of telling you a way to look at how to look at diversification. We talked about correlations, and again, it's a fancy way to say how asset classes or different investments react differently to each other. And the lower the correlation number, the lower things move in tandem with each other. But some investors really think that they choose a wide variety of stocks that are diversified, right? I have a small cap fund, and I have a large cap fund. I have an international fund, and I have a value fund, and I have a growth fund. And so I'm diversified. Well, it's true to a point, but that's like saying the Senate's diversified because they have all 50 states represented. But the Senate plays a part of the legislative branch the same way the Senate plays a particular well-defined role in the overall system of government, just the way stocks play a particular role in your portfolio. So really a well-diversified portfolio is one that's designed to avoid having a single asset class dominate the outcome of your portfolio. And so here we're looking at three major economic eras, or environments you could experience as an investor over an economic cycle. We have deflation, low inflationary growth, which are basically the good times, bull markets, and inflation. Now, bonds have historically done well in a deflationary or recessionary environment, and we saw that back in the 08-09 time period when bonds did well versus stocks. And more recently, earlier this year in January, when the stock market started off with a correction down 10-12% in the S&P 500, where U.S. Treasury bonds were up and positive, so that if you own bonds during that time period, you certainly would have offset losses from stocks, and it would have been a good way to be positioned at that time. Commodities have led the way during inflation. Now, we haven't had inflation since the 60s going all the way to the early 80s. The point here is commodities, if you look at the 1973 to 1981 time period, commodities led the way during that time period. Backing up a minute, if you look at the deflationary time periods, the Great Depression era, 1929 to 1941 was 13 years. We see that bonds did well. And again, in 2000 to 2014, we saw that bonds did well. I just mentioned commodities. They did well in 73 to 81. And then we talked about the low inflationary growth time period. Stocks would be the leader there. And that was a 42 to 65 time period in 1982 to 1999, which is the bull market, which included the tech and telecom stocks in the late 90s that did well. That was the Microsofts and Oracles and things of that nature. But really, what we're trying to show you here is that each asset class can be volatile by itself, right? We saw that bonds were even volatile, or could be, right? But you can actually fight fire with fire by combining different asset classes so they can offset each other because they have low correlations and going to react differently in different economic environments. And so really what we're trying to do here is say, sure, we want to invest in stocks. That's the growth engine of our portfolio. But be aware of, acknowledge and account for things that can derail that growth, which are something like inflation, which we could have at some point in the future, or a recession. Even talks about, recession-like chances even now with oil prices being as low as they are. And so really, that really kind of sets us up to say diversification really means looking at buying or investing in different classes that act differently in your portfolio, so then you don't have a single asset class or a single stock or bonds or different things like that that are going to control your destiny in your retirement planning. So finally, we want to consider some things, and we want to build an allocation in our portfolio that provides that true diversification, like separation of powers, like the executive, judicial, and legislative branches of the government. We want to stay prepared for the changing economic environments with a strategic allocation. So you're probably going to want to own some bonds. You probably want to own stocks and some other asset classes, whether it's commodities or some things that act differently, like real estate maybe or something like that. 3, we want to pursue tactical opportunities, and that means overweight or underweight things depending on where the stock market or the economic environment is doing. So for instance, if we have low inflation, which we do right now, and the growth prospects look well, we've seen stocks do very well the last 5 to 6 or 7 years. And the unfortunate event that people happened, they got scared out of the stock market in 2008 and 2009 because that was a horrible time period, understandably so, but they missed out because they got out of stocks and they didn't enjoy the last 6 or 7 years. Up until recently, stocks did well. Now we saw they sold off, that they've kind of recovered back again. But the point is, we don't know when those time periods are going to come, how long they're going to last. But I guess our point is let's kind of be there in our portfolios to kind of understand, look, we're going to be prepared for a variety of environments. We don't know what are coming, but let's just be there, okay? And so that kind of concludes my prepared statement. I want to hand it over to Tori to see if there were any questions during my presentation. I'll be happy to answer those. My time is your time, and I'll hand it over to Tori.
Great. Thank you so much, Tracy. We really appreciate you sharing your time and knowledge with all of us here today. And we will now start addressing some of the questions that have been filtering in. Please remember that if you have any questions, you can submit them using the Q&A tool on your webinar menu. And as always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. So now we're going to go ahead and move over and see if we have any questions that have come in throughout today's presentation. Our first question for you, Tracy. We are using percent of income on these examples. What is the actual value or average income?
Well, so if that's a good question. So if we had $100,000 a year salary, and again, granted, we just try to make round numbers to make it easy for sake of example, and we took a 10% annual contribution from that, that would be a $10,000 a year contribution. So the value of your contribution would be 10% a year. And then as you can see, it shows the 10% a year if you make 12% a year or 6% a year, or the long mountain chart, which shows the long mountain with the four different investors, ultimately with those reacted. But if you basically take the percentage, 10% or 20%, and we explain whether it's $100,000, I believe is all the examples. Then if it's a 10% savings rate, it would be 10%. It would be $10,000 a year. If it's a 20% savings rate of $100,000 income, it'd be $20,000 a year in savings.
Great. Thank you so much, Tracy. Our next question. My salary is closer to $60,000 a year, so obviously my returns would be much lower, correct?
Well, your returns probably wouldn't be lower, but if you use a 10%, and we're going back to the example from the first question, if we use 10% of $60,000, you'd be saving $6,000 a year versus somebody that saved 10% from $100,000 income, which would be $10,000 a year. Your returns would not be lower. However, your contributions would be lower. What you could do, instead of saying I'm going to save a percentage, you could say I can afford to save a certain amount. And so if you wanted to save more than 10% of a $60,000 a year salary or $6,000 a year, and you said I can afford to save more, say you want to save 9%. Well, 9% would be 15% of $60,000 savings. So you can do it a percentage of income, which is probably the easiest way to do, and you can simply calculate that by taking your salary, $60,000, and then putting it in an Excel spreadsheet or a calculator and do 60 times 0.1, and it'll give you 6,000. 60,000 times 0.15, which will give you 9,000, et cetera, and play with it. And then it kind of gives you the absolute amount, and that goes for the same person that asked the actual dollar amounts. And then you can determine by the percentages, you would do, 10% is 0.1, 20% is 0.2, et cetera, 15% is 0.15, and then multiply that times your salary, and that tells you the actual dollar amount that you'd be saving. But ultimately, your returns are going to be based on what you invested in. So therefore, if you invested in the stock market at the beginning of the year and you put $6,000 at the beginning, you put all your money at the beginning for ease of argument for this example, and the stock market returned 20% at the end of the year, you would have made 20%. Whether you put $6,000 in it or $6 in it, you would have made 20%. Now, of course, if you have $6,000 versus $6, you're going to make more money on 20%, right? Because you're making more off of what you invested more in it. But your return percentage will be the percentage of whatever you invested in and how that works out.
Thank you, Tracy. I would just like to point out as well that we do have financial calculators available on the Pensionmark website. If you go to www.pensionmark.com and then go to the Participant Education Center on the website, you'll find various financial calculators that can help determine your rate of return based upon what amount of money you're able to contribute. So I'd also just like to encourage you to use that resource if that's something that you're interested in. And then Tracy, looks like we have. Thanks, Tracy. It looks like we have our last question here, and it says, what portfolio mix works the best in a low inflationary and low growth period?
That's a great question because that's what we've been experiencing now for the last few years. Our GDP was really almost nothing. It was slightly revised to positive, and GDP is just the kind of productivity of the United States economy, and it shows how well are we growing or not, and we really weren't. Most economists are expecting us to grow anywhere between 2 to 3%, depending on what talking head you're listening to. So it's a relatively low growth environment. We have low inflation right now. In fact, the Fed, the central bank of the United States, the Fed, is hoping to stimulate some type of inflation because we don't have any right now. And of course, low oil prices are not helping things because it makes prices so cheap. Gas is cheap for consumers. It's cheaper to ship groceries to grocery stores, cheaper to buy clothes because it's cheaper to make them and cheaper to ship them. So what does well in a low growth? Well, as we can see here, we don't have a lot of direction in the economy. So what's happened since the beginning of the year, to give you a good example, is the stock market started off horrible. In January, we were at one point down through the market low of February the 11th. We were in correction territory. I think the S&P was down 12 or 14%, something along the lines of that, in a matter of a month and a half, a month and a week. So pretty bad times for stocks. At the same time, bonds are doing really well. And so bonds, the Treasury bond was up 2% or so, 1.5%, 2%. It's not up a lot, but it's better than being down 12%. So certainly it would have helped to have a combination of stocks and bonds during that time period. And I took into consideration gold. Now, gold is a little harder to buy during in a retirement plan unless you have an individual retirement plan. But gold actually is up 17%, I think, year to date. So it's done really well this year. So you would have. So I guess what I'm trying to say is there's not an optimal portfolio. Depends on the person. Depends on how far you are from retirement. But I think what you're asking, what I could answer is what asset classes do well then. And I would say a mix of stocks and bonds certainly, because you have uncertainty right now. And so is there going to be more data that comes out of China that says the global economy is slowing, that spooks the stock market? We had that last August as well. And then at that time, bonds would do well. When the market rallied from a market low from February the 11th through, I think, the 22nd, the market was up quite a bit. Bonds didn't do well then. The stocks kind of came off their bottoms, and bonds kind of gave back up some of their gains. And so this is a long way of saying is make sure that you have these different asset classes that act different in these different economic environments, because you don't know what's going to happen. And in a low inflation, low growth environment, we didn't show that on here. It's up in the air because there's a lack of direction. It's kind of like you look at the United States economy or even the global economy. It's kind of like a ship or say a sailboat in a very slow moving stream, and it's kind of bouncing around, and it might bump into a rock here, or it might spin around and go kind of backwards for a little bit, and it might keep going forward. And so there's not enough data to tell us which direction the economy is going to go in. There's certainly no inflation on the horizon, not right now, but we certainly could have some. And so the best thing to tell you is to invest in enough low correlating asset classes, such as stocks and bonds, to where you're prepared for anything that could happen.
Thank you, Tracy. It doesn't appear that we
Sure.
have any more questions at this time, so we're going to go ahead and conclude our webinar session today. But we wanted to thank you again, Tracy, and thank you attendees for your participation. Hope everyone has a great day, and we really look forward to our next webinar series with you. Take care, everybody.
Yes. Thank you, everybody.